In this video, we are going to look at tax effect accounting, some practice questions and answers about making journal entries. The first question we have here is determining the tax base of assets. We've taken a motor vehicle here, purchased on 1st of July 20XO for $100,000. And there is no expected residual value. The depreciation rate for accounting records is 20% on straight line basis. The depreciation rate for tax record is 25% on straight line basis. It's required to determine the tax base on 30th of June 20x1, 20x2, and 20x3. So let's draw up our accounting records now. The cost is $100,000 across the 3 years, but the accumulated depreciation for the first year is at 20% is $20,000 on straight line basis, and second year is $40,000, and third year it's $60,000. So the carry value correspondingly for X1 is 100,000 less 20,000, 80,000, and for 20x2 it's 60,000, and 20x3 it is 40,000. Let's now look at the tax records. The cost is just like in accounting records, but the accumulated depreciation is different because the tax depreciation rate is 25% on a straight line basis. On 20x1 it is 25,000, and in x2 it is 50,000, and x3 it is 75,000. So the tax base, which is equivalent to carrying value of accounting records on the first year, is 100,000 less 25,000, and that's 75,000, and in x2 it is 50,000, and in x3 it is 25,000. When we look at carrying value and tax base, we can see for the x1 carrying value is 80,000, but the tax base is 75,000. And in x2 carrying value is 60,000, tax base is 50,000. And in x3 carrying value is 40,000, and the tax base is 25,000. In all 3 years, the carrying value and the tax base are not equal. When it is not equal, there is a difference, and that difference is called a taxable difference. So for us to determine the tax base, we can take the carrying amount on the first year. On the first year, it was 100,000 less 20,000, and the carrying amount was 80,000, and the future amount of deductible for tax purposes is 75,000. So that was the amount that we had, and less the future taxable economic benefits, because the carrying amount is going to become our future cash flows is 80,000. So we deduct that. When we deduct the carrying amount from the future taxable economic benefits, which is 80,000, our tax base is 75,000. So the tax base that we calculated can be computed this way. And for the second year, our carrying amount was 60,000, and the future amount deductible for tax purposes was 50,000 unless the future taxable economic benefits, which carrying amount in the second year is going to become, which is 60,000. So the carrying amount 60,000 less future taxable economic benefits 60,000, and the future amount deductible for tax purposes is 50,000, and that's what we calculated. Similarly, for X3 year, carrying amount is 40,000, and that's going to become future taxable economic benefits, and we got to deduct that, and we now must add the future amount of deductible for tax purposes, and in year 3 our tax base was 25,000, and therefore that equals to 25,000. So this is a detailed explanation about calculating tax base, but the table that we looked at shows how we can compute the tax base with the tax depreciation. Here's question 2. In question 2, interest earned not yet received for the year ended 30th June X1 is $10,000, and we are required to determine the tax base on 30th June 20 X1, X2 and X3. So let's construct our accounting records. Interest receivable is 10,000. It's an asset. It's a current asset, and the carrying value is 10,000. In X2, that interest is going to be received as cash. Therefore, there is no interest receivable in X2 in the accounting records, and therefore in X3 as well. If we look at the tax records, the interest receivable, although there's in accounting records, it is not there for the tax base because it is still not accessible for tax purposes. It has not become cash. But in 20X2 year, that interest receivable becomes a cash inflow, and that's going to get assessed by the tax. Therefore, the tax base becomes 10,000. But in 20X3 year, because it's all realized, there's nothing there. So if you look at the 30th of June 20X1, our carrying amount is 10,000, and the future taxable economic benefits which we have to deduct is 10,000, and the future amount of deductible for tax purposes is 0. So therefore the tax base is 0. So when we look at this table, we can either go through this detailed type of calculation or just look at the table and determine the tax base. So if you just look at the tax records table, in 20X2 our tax base is $10,000, and in 20X3 our tax base is 0. Let's now look at determining the tax base of liabilities. Previously, we looked at determining the tax base of assets. So we're going to look at liabilities now. So in this example, revenue received in advance for the year ending 30th June 20X1 is 20,000. We are required to determine the tax base for 20X1 year, X2 and X3 year. So let's construct the accounting records. Revenue received in advance become unearned revenue. So it's a liability. because we still have not received cash and we are awaiting cash. So that liability in 20x1 in accounting records is shown there. And the carrying value of that liability is 20,000. But in the X2 year, that liability is going to get extinguished because we are going to get the cash for that. And in 20x3, there's no effect. Now let's look at the tax records. In the tax record, in 20x1, there's no cash inflow. Therefore, there's nothing to assess. Therefore, the tax base is 0. But in 20x2, that unearned revenue becomes earned revenue. There's cash inflow, and that revenue becomes cash inflow. And the tax base for 20x2 is 20,000. And 20x3, there's no effect. If we look at the detailed equation, we can look at there's carrying amount of 20,000 liability, and the future taxable economic benefits is 0. We have to add if there is any future taxable economic benefits, less the future amount deductible for tax base is 20,000, and it's going to get deducted in next 2 years, and therefore tax base through that equation is 0, which we can see in the tax record table. So looking at that table, we can determine the tax base for X2 year, which is 20,000, and for X3 year, it is 0. Here's another liability, and we will determine the tax base of this liability, which is unpaid salaries. Unpaid salaries is an accrued expense, and that's for the 30th June 20x1, and that's $5,000. We are required to determine the tax base for 20x1, x2, and x3. So constructing the accounting records, accrued expense liability is $5,000, which is recorded on the balance sheet, and the carrying value is $5,000. In X2, that liability is going to get settled, and therefore there's no liability that exists in X2. Carrying value is 0, and in X3 there's no effect. Let's now look at the tax records. There's accrued expense liability, and that has to become cash outflow. But in X1, there's no cash outflow. So therefore the tax base is 0. But in X2, there is a cash outflow of $5,000, and tax base of that accrued expense is $5,000. And in X3, there's no effect. So if you look at the detailed equation, we can say that carrying amount for 20x1 is 5,000. And if we add the future taxable economic benefits in that year is 0. And we deduct the future amount of deductible for tax purposes, and that is $5,000, and the tax base is 0. But we can see that from our table that we constructed for the tax record. So similarly, next to from that table we can see our tax base is $5,000, and 20x3 tax base is 0. Here's a special case of determining tax base of liabilities. In this special case, the loan payable is not deductible for tax purposes. But typically it is deductible. But for this illustration, we have taken as not deductible. Because it's typically deductible and this is a special case, we don't consider this as a permanent difference, but we consider it as a temporary difference. However, there is no effect, and that's why this example is included here. So in 20x1, the loan payable is 7,000, and we are required to determine the tax base of 20x1 year. So the carrying amount of the loan payable is 7,000, and the future taxable economic benefits, because it's not deductible for tax purpose, 0, minus future amount deductible for tax purposes is also 0. Therefore, the tax base is 7,000. So the carrying amount is 7,000, tax base is also 7,000. So there's no difference. So therefore, there's no tax effect here. There's no temporary difference here. In question 6, we are required to prepare and extract balance sheet of accounting and tax purposes. So we looked at these questions. We looked at questions, and these questions, there are 5, and the first one was motor vehicle, and the carrying value of that motor vehicle in 20x1 was 80,000. That's after deducting the accumulated depreciation, 20,000 from 100,000 cost. The tax base for the same year was 75,000 because the accumulated depreciation was 25,000. In question 2, the interest receivable was an asset for accounting records is 10,000, but there was no cash that was received. Tax base was 0. So those were the 2 assets we looked at. And now let's look at the 3 liabilities we looked at. The first, that's question 3, was unearned revenue. The carrying value was 20,000, but there was no revenue that was realized in that year. There was no cash. Therefore, the tax base was 0. And the accrued expenses was 5,000, the carrying value, and there was no expenses paid out, and the tax base was 0. And question 5 was loan payable, which was the special case we brought in, and the carrying value and the tax base was equal. In question 7, we now constructed the balance sheet extract. We are now going to determine the tax effective difference based on the balance sheet extract that we constructed. So if we repeat that balance sheet and now look at the difference. First one, question 1, carrying value was higher than the tax base by $5,000, and it's an asset base. So that difference of $5,000 becomes a taxable difference, because that $5,000 which is contained in the carrying value is going to become cash inflow in the future and it's going to get taxed in the future. In question 2, there was interest receivable, carrying value was 10,000 and the tax base was 0. The difference is 10,000. It's taxable difference because the carrying value was higher than the tax base and it's an asset. And there is future cash inflows that we realize in the future, and that cash inflow for the tax purposes become taxable. Let's now look at the liabilities. The first one is unearned revenue. Question 3. The carrying value is 20,000 and the tax base is 0. And the difference between the two is 20,000 and is deductible. The carrying value here is higher than the tax base, but it's a liability. Liability means there's future cash outflow. So there's future cash outflow of 20,000, which is deductible for tax purposes. Question 4 is accrued expenses. The carrying value is 5,000 and the tax base is 0. And here the carrying value is higher than the tax base. What it means is that in the future there would be cash outflow and that outflow becomes a deductible expense for tax purposes. In question 5, loan payable, it was a special case that we included. Carrying value and the tax base is same, therefore there is no effect on the difference. In question 8, we are required to prepare journal entries for the tax difference identified from the balance sheet extract, and the corporate tax rate is 30%. So we found that the indirect asset motor vehicle where carrying value was higher than the tax base, and that was 5,000. The tax component included in that is 30% of 5,000, which is 1,500. And that 1,500 becomes a liability which is deferred for the future, and that liability, interest receivable, is again our carrying value was higher than the tax base. 30% of that is 3,000. The deferred tax liability is $3,000, and that's going to increase the tax expense. So in our first question, our income tax expense increases by 1,500 because it's a debit account, and the deferred tax liability increased by 1,500. In our question 2, income tax expense increased by 3,000 and our deferred tax liability increased by 3,000. And question 3 and 4, in question 3, which was a liability unearned revenue, carrying amount was higher than the tax base by 20,000, but it's a liability. 30% of that is 6,000. And because there's a future deduction, it becomes a saving, and that amount becomes a deferred tax asset. And that's going to decrease the income tax expense by 6,000. In question 4, unearned revenue, again the carrying value was higher than the tax base, and that was 5,000, and 30% is the tax component or the tax effect of that. And because there's outflow in the future, a deductible amount, and there's a saving, and that saving is shown as a deferred tax asset 1,500, and that's going to decrease our income tax expense of 1,500. As you can see, in these examples, in the tax effect accounting, our journal entries are about income tax expense and the deferred tax liability or deferred tax asset. It is not about income tax payable, because income tax payable is calculated separately, and that actual amount has to be paid. And these adjustments that we do here is to adjust the accounting records, is not to adjust the tax records. Tax records are maintained by the tax office. In question 9, we prepare journal entries for reporting purposes. So for reporting purposes, we can journalize them by clustering them. And if you look at the deferred tax liability, it's coming from question 1 and question 2. There was 1,500 and 3,000, and it's 4,500. And the deferred tax asset are coming from question 3 and 4, 6,000 and 1,500, and that's 7,500. So if we take the deferred tax liability, which is 4,500, and the deferred tax asset is 7,500. So there's more debits compared to credits of 3,000, and that difference is the income tax expense or income tax income, 3,000. So the journal entries, the debits and credits equal. And if we do the same exercise, just like in the workings, by taking the debits and the credits of income tax expense, that equals $3,000. But if the entity has a special case, that means a legally enforceable right to set off current tax asset and current tax liabilities and pay tax to the same tax authority such as ATO, and intends to settle tax on a net basis or realize assets and liabilities simultaneously, then in that instance we can net off, or we can take the difference between the deferred tax asset and deferred tax liability, and when we net off 7,500, which is a debit, and with that the 4,500, which is a credit, and the difference is 3,000, we can say the deferred tax asset is 3,000 debit, which is the net amount, and the credit is the income tax expense, and that's $3,000. But that's done only under special circumstances.